Hi, I'm Bob French. Right now, the coronavirus has done a pretty solid number on the financial markets. As of the close on April 14th, 2020, the day before I recorded this, the S&P 500 was down about 12% on the year. And that's a substantial improvement over what we saw a few weeks back. And while everyone talks about the stock market and the numbers are bigger and flashier, the bond markets are about twice the size of the global stock market. And actually a whole lot more interesting when you start pulling back the layers. Right now, and also during pretty much every major downturn in the markets, we're seeing what's called a flight to quality. Basically, when things are looking rough for stocks, investors are looking for a way to get out and park their money in a safe place to wait until everything's pretty much blown over and it's safe to emerge again. They're pretty much just trying to avoid losing too much money. So they sell their stocks, pushing markets down even further, and start buying up safe bonds, or what they consider to be safe bonds. And US Treasury bonds are generally regarded as the safest bonds out there. Essentially, they're looking for the bonds that they don't think will default, that will continue paying out no matter what happens in the markets. So these nervous investors are out there buying up all the US Treasury bonds, as well as any other bonds they think are going to be okay, that they can get their hands onto, which means they're driving up the price of those bonds. In turn, this means that they're pushing down the yields on these bonds. These investors are effectively accepting a lower interest rate on that loan to the government. Bonds are like a seesaw. When you push up the price, you're also pushing down that yield. You're paying more for those payments from the bond issuer. Remember, assuming a bond doesn't default, which is kind of the point of this whole flight to quality thing, we know exactly what the cash flows on a bond will be. So when you push up the price, the yield has to come down. And during rocky times, investors are okay with that. They value the security of something like a treasury bond a lot more than when markets are charging ahead. Another way to put it is that they're a lot less comfortable with credit risk. They're demanding a much higher premium to take on the risk that a bond issuer will default. They just want to be reasonably sure that they're going to get their money back. Or in some cases, just not lose all that much money. They want safety. And that's perfectly reasonable. But flights to quality are a really obvious example of the power of diversification. During normal times, stocks and bond prices don't really move together all that much. They're reasonably independent. But during a downturn, where we are seeing a flight to quality, we see them moving in pretty much opposite directions. And you'll often find that high-quality bonds are one of the few bright spots in your portfolio during a bear market. A good example of this is 2008. That year, the S&P 500 index was down 37%. But 5-year US Treasury notes were up over 13%, and 10-year Treasury bonds were up over 19%. During the dot-com crash, from March 2000 through October 2002, the S&P was down almost 14%. But both the 5 and 10-year Treasury bonds were up almost 12%. So if a flight to quality happens, what should you do about it? Or, not to put too fine of a point on it, what should you do about it now? Should you go out and join the crowd buying up all the highly rated bonds that you can get your hands on? Well, you probably shouldn't really do much to your asset allocation, assuming you've got a good plan built around your financial goals and risk tolerances. It's all but impossible to time the market, which is what this would be, no matter how you want to frame it. Markets are based on new information, and specifically how that new information squares with what the markets expected. We can't predict what the markets will do next, and trying to guess is just introducing randomness. You'll be right about half the time and wrong about half the time. But again, assuming that you've put in the work and built an appropriate asset allocation for your situation, then you'll probably want to just sit tight. Downturns, which is really the only time you'll see a flight to quality, are something that you should expect to deal with as a long-term investor. Flights to quality are a response to short-term traders getting out of the stock market during tough times and looking to park their money in the safest places that they can find. As a long-term investor, they're more an interesting phenomenon than anything else. Though it might be a decent time to start checking whether it's worth refinancing your mortgage. If this was helpful, be sure to like this video and subscribe to our channel so you can see what we're up to. If you have any questions on this or any other questions that you would like to address, just drop them in the comments below. You can also check us out on the web at retirementresearcher.com and make sure to sign up for our weekly newsletter to keep up to date with everything that we're doing.